Trades, Trends, and Kyle's Takes. That's my new channel name, and I'm going to try it out for a while. I'm your host, Kyle. Welcome back. Today is August 19th, 2024. Wow, markets are just continuing on this run. We are just shy of about 1% before we are back at all-time highs and drilling on upward. I am just so excited to finally be able to pretty much confirm that this was just a big shakeout, a big dip, and we are racing right back towards the all-time highs. I'm checking now, we are just about 1.08% shy on the S&P 500 from breaking new records, and that might come within the next week and a half or so. I'm a little hesitant to say that the momentum is strong enough for us to just keep plowing right on up towards there over the next couple of days, but it might very well just do that. We're breaking through more and more resistance levels, so I'm continuously skeptical that we are going to roll back over downwards. I don't want to say that that can't happen, but more and more it's looking like that's not going to happen. Looking over at the Nikkei, they are doing just as well. They were cooling down a little bit over the weekend and the early session from last night, but now rolling into the late afternoon Monday session, I suppose that would be Asia's Tuesday session. They are popping right back upwards and cruising right through what should be some resistance levels. It looked like they were going to turn over and dip back down below here just briefly, but now that is quickly becoming a rejected theory. So markets are really just rallying hard, and what is the cause of all this? And I think to answer what the cause is, we first have to answer what the cause was of the drop in the first place, right? The cause of the drop was largely influenced from Japanese markets, and what that caused was just a massive amount of uncertainty of whether or not that little hiccup had been resolved, if further interest rates were coming for Japanese markets, and we have some information now on that. And so now that some of that uncertainty has been quenched, and we see the volatility index, VIX, we see that coming way back down from where it was. Markets are back kind of in that happy stage, and we don't want that panic. We don't want that uncertainty. And so if that is out of the picture, then we can kind of go back to what we were doing, which is just clicking on up day after day. So I'm expecting this action in this direction to continue. Of course, anything can happen. I don't know exactly where markets are going on any given day. It's anybody's guess. But at least from what we've been seeing and from what I've been suggesting, that fundamentally nothing has changed, right? We're still looking at the same unemployment data. We're still looking at the same jobs numbers, the same interest rate, the same, inflation is staying the same. We're hoping to have inflation tick a little bit lower. We're hoping to have unemployment not be rising as quickly. More data on that to come. Now, next week we do have the Federal Open Market Committee's minutes from their last meeting, and typically that's a non-event, but sometimes there's something in there that alludes to what direction they might be thinking of for their next meeting. But aside from that, we just have continued weekly unemployment numbers and just data that we get on a regular schedule. So Wednesday, Thursday, I think is where we might see some volatility, if anything. Otherwise, everything's looking great. Even crypto is holding steady for now, though I'm expecting that to be making a move lower here any day now. So to add on to all that, I want to go over an article here by Yahoo Finance, and they were interviewing Goldman Sachs chief economist Jan Hatzius here 17 days ago when he raised his recession probability from 15% to 25%. And I think that might have had a little bit of influence in markets and on participants. But lo and behold, he has now come back to the headlines to say that he's slashing his US recession odds from 25% down to 20%. So it seems a little bit reckless, possibly irresponsible, a little bit inappropriate to go from 15% to 25%, and now only 17 days later, what has really changed? aside from we had unemployment tick up a little bit higher than expected, and we also had inflation not tick down like expected, the data has been somewhat stagnant, not necessarily horrible, but not great. So possibly he's now looking at this data and saying, well, the conditions aren't quite accelerating at the rate that we thought they were a month ago or a month and a half ago or 17 days ago, I suppose. And so the narrative is changing. It's just how can somebody of such prestige working for such a well-renowned company such as Goldman Sachs come out and say we're 25% chance of having a recession, and not even 17 days later now we're lowering that number that was just raised. I've been saying this whole time that fundamentally the data is not significantly changing, and that the Fed has not significantly changed their tune to whether or not that they feel that the data is making them confident in their ability to now start lowering rates. So Goldman Sachs, if you need a new economic analyst or chief economist, geez, I'll have to post a job application over there. Maybe this guy will not be around too much longer. The article goes on to say that the suggestion by Mr. Hotzies and the unwinding of the yen carry trade, and that was the effect that we were feeling from Japanese markets, sent shudders across markets worldwide. So the article is somewhat suggesting that statements by this individual and the yen carry trade were what was sending massive drops and volatility throughout the markets in previous week. So now Hotzies is saying, quote, the economy is doing just fine. He pointed to improved economic data and a healthy corporate earnings season. Quote, the lower recession risk has strengthened our forecasts that the Fed will cut by only 25 basis points at the September meeting. That's been our forecast for a long time, but I think with more worries about recession, there was a real possibility that it might be a 50 basis point cut. So he's alluding to that they thought the Federal Reserve was going to do a 50 basis point cut come the September meeting, and now they're saying, well, maybe they're only going to do a 25 point. Now, I've stated this before, but not to be too contrarian, personally, I don't think the Fed is going to cut in September. I think all these analysts and all this financial media is alluding to it, almost kind of setting the stage so that the Fed can come out and disappoint. And I think they're trying to intentionally kind of put the Fed in a tight spot of, well, the market's all expecting a 25 to 50 basis point cut, and so you better do it, because you're going to be letting everybody down if you come out and offer nothing. But I don't think Jerome Powell does not have a history of abiding by the market's expectations, right? He has a history, and he has come out and stated this himself, and he has made it very clear that though he finds all these takes very interesting and very intriguing, that they don't have a significant impact on the ultimate decision that the Fed ends up taking. The article goes on to say that the latest ISM services report, which includes data on business activity, new orders, employment, and supplier deliveries, clocked in at 51.4%, up from 48.8% in June. Numbers over 50% as seen as positive for the economy. Most companies in the report said business was either flat or expanding gradually. The number of people in the U.S. submitting new applications for unemployment benefits fell to a one-month low last week. The number continued a downtrend seen just a week prior. Also, a week ago, the Commerce Department reported that retail sales rose 1% in July, and I did a video on that. I believe that was the video that I released on the 15th, and I also theorized that that might have been why the market moved so much that day, was because that data came in so much higher than expected. The largest increase since January of 2023, supported by robust gains in online shopping. Sales in June fell a modest 0.2%. Now listen to this quote from CFO John David Rainey of Walmart. He says the consumer is hanging in there. He added that the back-to-school shopping season is off to a good start. The corporate earnings season has gone quite well. The majority of well-known public companies are easily beating sales and profit forecasts, not shocking the masses with giant misses. Outlooks have been solid, which I am not sure. I can't keep track of every earnings report that comes out, but I was looking at a number of them as they were coming out over the last 2 weeks or so, and I don't know if I would say outlooks have been solid. Some of them have been a little bit hesitant, maybe a few misses in the tech sector, but Wall Street has began to move beyond the shock sell-off following the jobs report earlier this month, suggesting to clients that they dip their toes back into less exuberant waters. These articles just kind of bounce around. First, we were talking about how Jan Hatzi's was the cause to the sell-off. Then we were suggesting that the yen carry trade was the cause to the sell-off. And then as I scroll further down, now we're suggesting that the shock sell-off was following the jobs report earlier this month. I think it all plays a little bit of a part into the overall move. You know, it kind of happens back to back, day by day. This is just the nature of the beast. This is just how things move. I was happy to get that negative 10% move. We came just down to where I like to start buying in. I don't like to start buying in above negative 10%, but it came just down to negative 10.1, negative 10.2% or so. And I started adding to positions. I have been posting my trades. I have not made any trades today or on Friday either, I don't believe, but check them out in the link below, and you can see my positions in Dollar General and in Carvana. Carvana is doing very well for me right now. I'm up about 16% or so on the position. Now, if you've been liking my content so far, please consider liking and subscribing. Your support means so much to me. I'm excited every day to come back and see the news and see how my channel is growing and seeing some connections that I'm making and getting comments and all that good stuff. I'm really enjoying this whole YouTube progress. So if you've been viewing and you have subscribed, thank you again. It means a lot. I hope to be back tomorrow with even more financial news. That is all I have for today. Again, I thank you all, and I will see you very soon.